Good morning, everyone. Thanks for attending. There we go. Okay, now I got it. So I will be making some forward-looking statements regarding production and so on at the mines and projects. So I do encourage everyone to do their homework, and also for any U.S. investors that might be watching the webcast. It's actually been a very good year for Great Panther at the current operations, despite the environment with lower metal prices and lousy markets. We've been doing great things at the operations and brought on a couple of excellent new projects that we're moving towards production. So I'll be telling you about those today. Just as a quick summary, the company is very much focused on precious metals, with more than 90% of our revenue coming from gold and silver, and a small amount from lead and zinc from one of our mines. We're focused in Mexico. The operations are 100% owned, and we have a new project in Peru where we hope to be able to replicate the success that we've had in Mexico. So we're moving that project towards production as well. Perhaps most importantly in this environment, we have a very strong balance sheet, about 19 million in cash, 35 million in working capital, and no debt. So we're in an enviable position compared to some of our peers. We've been able to achieve that through a very disciplined approach towards cost cutting, getting the grades up at the operations, and improved production, and just working on efficiencies all around. And while doing that, we've not only been able to achieve significant growth at the operations, but we have tremendous growth potential through the two new projects that I'll tell you about. So just looking at the production growth that we've achieved, you can see quarter over quarter, fairly consistent growth. Q3 was relatively flat compared to Q2, but the overall trend has been up. And we've been able to do that while reducing the amount of tons that we put through the plant. And the reason for that is that the grades are higher. And so when you're producing more ounces from fewer tons, that has the result of driving down your unit costs. And you can see here that the cash costs have come down significantly below the spot price, which is shown in the solid bar. And even our sustaining costs, which includes virtually everything that the company does. So that includes the extra drilling for resources, that includes mine development, includes all our head office G&A. Those sustaining costs are still below the current spot price of silver. So we're still able to generate cash flow even in this environment. It's also been assisted by the strong U.S. dollar because our costs are either in pesos, Mexican pesos at the operations, or in Canadian dollars at head office. Meanwhile, our revenues are in U.S. dollars. So the exchange rate certainly has helped us this year. So I put together this slide just last week for our management meetings, so it's not actually in the presentations that you have with you. But it was an interesting comparison just to see where we sit with respect to our peers in the industry. And I've looked at this not just from the point of view of consolidated sustaining costs for the companies, but the individual operations as well. And while it shows that we're doing well both on an individual operation standpoint as well as for the company, maintaining profitability. But when you look at some of the individual mines and companies across the board here, it shows that the industry itself is fairly challenged at these prices. So I don't think it's really sustainable for too much longer at these levels. And at some point soon, hopefully we should see a return to more respective prices. Otherwise, it's going to start to affect the mine supply side of the equation. So by driving up production, driving down costs, that has, and again with the strong U.S. dollar, that has increased our revenues overall. And so we've benefited from that, and of course that helps our gross profit margins as well. And then we can rechannel those profits back into the operations and into the new projects. So just looking at the operations themselves, the mines are in central Mexico, Guanajuato area, and also up in Durango State at the Topia mine. And one of the new development projects we have is just south of the Topia mine called Guadalupe de los Reyes. In Peru, the new project that we have down there is just east of Lima, so very good access. It's only about a 3-hour drive on the Central Highway, just outside of Lima. Mexico and Peru, of course, being the two top silver-producing countries in Latin America, and depending on where you place China these days, either number 2 or number 3, you could say Mexico and Peru are certainly within the top 3 in the world, anyways, for silver production. So for a silver company, it's a great place to be focused. So just taking a quick look at the existing operations, our flagship operation is Guanajuato, central Mexico. This includes a little mine that, I shouldn't say little, new mine just outside the city of Guanajuato that we initially referred to as a satellite operation, but it's called San Ignacio, and it's in Q3 contributed about 52% of the production now to the Guanajuato mine complex, and by the end of next year it'll be up to about 80% of the production going through the plant here. So very significant contribution. Overall, the Guanajuato mine complex contributes about 3/4 of the company's production. It's just silver and gold at these operations, but very good grades, which have allowed us to reduce the cash costs. And you can see here that cash costs below $5 an ounce of silver, and even our sustaining costs are below $10 at this operation. San Ignacio, as I mentioned, you can see it's just in the inset. It's just west of the city of Guanajuato, just west of the main operation and the plant. So the ramp is the mine is accessed by a ramp, and then the ore is just trucked around to the plant. It's about 22 kilometers by road, so it's relatively low cost to do that. Certainly much cheaper and faster than building a new plant. Lots of potential to expand the resource here. The area that we're mining is just within the blue box that you see in the northern corner of the property, and so still have several kilometers of strike length on these veins to expand the operation to the south. But as I say, this project should contribute up to 80% of the production for this area by the end of next year, so it's a very significant contribution for us. At the Topia mine in Durango State, this is silver, lead, zinc, so the small amount of base metals that we have comes from this mine. It is a smaller mine, multiple veins being developed. They are narrow veins, and so a little bit more labor intensive. Costs are higher, as you can see, but then again, the grades are much higher as well, about 360 grams average silver grades, and that helps to offset the higher costs. So the mine is still able to maintain profitability as well, even in today's environment. So overall, we have been increasing our production year over year. We've seen a compound annual growth rate of about 12% over the last 5 years. We started out this year with production guidance of 3.5 to 3.6 million ounces silver equivalent. But by the end of the second quarter, it was clear that we were going to exceed that, and we increased our guidance to 3.8 to 3.9 million ounces. And as we're getting close to the end of November now, I can quite confidently say that we will exceed the top end of our guidance for the year, producing somewhere in the neighborhood of 4 million ounces of silver equivalent. So it's been an excellent year for us in terms of production growth. And in terms of costs, we also reduced our guidance on costs from the start of the year down to $9 to $10 on the cash cost. But as you saw from some of the previous slides, we should be well below those numbers as well. And similarly with the sustaining costs, we expect to beat our guidance on the low side there also. So turning now to the development projects, I've titled this portion of the presentation a contrarian approach to growth. And as any of you saw from the first presentation this morning from Claude Béger, as investors, we like to think that we can buy low and sell high. And as an investor myself, I like to try and follow that approach as much as possible. And yet, here we are at a multi-year low, and a lot of people are still hesitant to buy. So as much as we like to think of ourselves as contrarian, it's sometimes difficult to do. But we've taken this approach in terms of acquiring new assets. And so at a time when a lot of companies are selling off non-core assets or just aren't able to continue with them, that's driven down the prices considerably. And we've spent several years looking for the right asset at the right price, and we've been quite disciplined in our approach in looking for that combination. And we've reached a couple of projects, or identified a couple of projects in the last year or so that we felt met those criteria. And we've approached these from a slightly different angle, in the sense that rather than just buying the projects outright and having to either go to the market, dilute shareholders to raise a bunch of money to do that, or go into debt, we've taken options on both of these projects. And that way we can de-risk the projects over a period of time, advance them at our own pace, and then it also spreads out the acquisition price. And should we be successful with the projects, then we would move ahead, make a production decision. And if both of these projects are successful, then they have the potential to more than double the size of the company within about a 4 to 5 year period. So it's something that we're very excited about. And so I'll just tell you a little bit about those. But what the projects have done is fill a gap in our project pipeline, where as San Ignacio moved from exploration through development and out the end of the pipeline to production, we left a gap in the middle that has now been filled by these two projects, the Coricancha and the Guadalupe de los Reyes in Mexico. So Coricancha in Peru, it's an underground mine. It's currently owned by Nearstar, based out of Zurich, and it was placed on care and maintenance by them in 2013. And so it's more or less sitting idle right now, but has excellent potential to be reopened. And we think that it's a mine that is better suited to a company the size of Great Panther. It's a narrow vein type operation, very similar to what we're doing in Mexico, and has great infrastructure. You can see the highway here in the picture. That's just 90 kilometers east of Lima. So out of the capital, you can be here in 3 hours. There's a 600 ton per day plant that's fully permitted. It's operational, and it is a polymetallic deposit. So it's about 80% precious metals, about 20% copper, lead, and zinc. So we've already started drilling on the project underground, and you can see the plant here in the foreground beside the highway. The mine itself is in the mountain across the valley in the background. The plant sits at about 3,000 meters elevation, and the mine goes up to a little over 4,000 meters. So it's getting up there, as for most of us, those of us that are used to living closer to sea level, but it's still quite manageable by Peruvian standards. Just on the slide, just to show you two things. One, that the grade here of the historical resource that was defined by Nearstar is very significant, around 5 grams gold and about 150 to 175 grams silver. So that's something that you need in this environment with low metal prices. So the grade definitely makes a big difference. And the second thing is just the size of this resource. We're looking at about 22 million ounces of silver equivalent in the measured and indicated category, another 125 million in inferred. And so as we continue our drilling and redefine these resources, we will be coming out with a new resource estimate in Q1 of next year that will factor in the lower metal prices that we see now. But so that in itself would normally reduce the size of the resource. But but we think that with the extra drilling that we're doing, that will add new ounces, and so the two hopefully will balance out each other, such that the overall resource should be somewhere in the same range as what it is now. So this is a very, very significant resource that, should we move ahead and exercise the option, will ultimately be attributed to Great Panther rather than Nearstar, and then that will go towards our own NAV, and we should see a fairly significant re-rating of our share price at that time when the valuation goes up. And we're able to do all of that for a purchase price of $8 million, including the plant and the resource and all the mining infrastructure and everything. By structuring this as an option agreement, we've paid $1.5 million upfront in May of this year. We're looking at a second option payment of $1.5 million in May of next year. In that first year, we'll spend $2 million on exploration, and then the second year, another $3 million on exploration and development. Should we exercise the option, it's an extra $5 million payable at that time in May of 2017. So a total of $8 million cash and $5 million in work, which we would have done anyways had we gone ahead with a straight purchase. So it's an excellent deal for Great Panther. It gives us 2 years to de-risk the project and move ahead. And with the plant sitting there, we figure about 4 to 6 months to get everything up and running. Startup capital is probably going to be in about the $15 million range, perhaps $20 million. Not overly significant. It's not going to be a huge burden for us. We should be able to make that decision in 2017, and then move ahead with the project at that time. As I mentioned, during the option period, Nearstar covers all the care and maintenance costs. So basically, we have all the upside with none of the downside. Back in Mexico, the Guadalupe de los Reyes project is a gold-silver project in Sinaloa, just south of our Topia mine. And this is a little bit earlier stage than Coricancha in the sense that there's no plant here, but it does have a significant resource. It's an historic mine going back to the days of the Spaniards. And significantly, you can see the grades here from the Spanish mining and even some of the more recent mining in the early part of the 20th century. The underground grades were in the range of 12 grams of gold and 900 grams silver, so a very, very high-grade operation. And again, can't emphasize enough in this environment how important grades are to keeping your costs down and keeping profitability. The previous resource and PEA, or preliminary economic assessment, that has been done on this project were focused on an open pit type scenario. And when you do that, it factors in a lot of waste rock, a lot of low-grade material, and it changes the geological model, the economic model, such that the grades are substantially lower. And when we took a look at this, we realized that it really should be viewed as a combination open pit and underground, because it's a vein type district, much like what we're already mining in Mexico and hope to be mining in Peru. So you can see the veins here. The zones on the left, the El Zapote, north and south, and Tajanitas are potentially amenable to open pit development. The rest of the areas are all underground targets, and particularly what was mined before at the Guadalupe system, and those are the areas with the higher grades. So these grades here that you see, the 1.73 grams and 1.5 grams, those were a result of the modeling for an open pit type scenario. So as I say, that factors in a lot of waste rock, a lot of dilution, and when we remodeled this internally, looking at an underground operation, the grades come up quite substantially into the 4-gram range, and we're currently doing some drilling on the higher grade zones and trying to develop a higher grade resource that would be more amenable to underground development. And we intend to have that resource out before Christmas, which should demonstrate that this project really is amenable to underground on the eastern part, and with a bit of open pit development on the west. And then from there we would move forward through through either a new PEA or perhaps even a pre-feasibility study next year, and pushing the project forward towards production. So again, it's an option agreement which helps to keep the costs down in terms of the payments. On this project, we have a lot more flexibility actually, in the sense that there is no work commitment per se. That we can proceed at our own pace on this project. And so if anything was to happen with metal prices where they suddenly collapsed, and we wouldn't be backed into a corner, and we could just step back, and as long as we made the option payments, which coming up in January, that won't be a problem, then we can maintain the project and just put it on the shelf for a little while. After making that payment in January, we'll make another payment January 2017. That will lock us in for 70% of the project. And to move beyond that and get the additional 30%, we just have to make a production decision and make an extra payment of $3 million to Vista Gold. That production decision can be made at any time. Again, there's no commitment on that. We can decide either to shelve the project for a while if metal prices stay lower, or we can move forward and start to develop a new mine. So that's entirely at our discretion. So it's nice to have that flexibility. In terms of capital structure for the company, we have 140 million shares on issue, trading on 2 stock exchanges. Most of the stock trades on New York on the MKT. Great liquidity there. Right now, even with volumes being as low as they are, we're trading around 600,000 shares a day between all the exchanges. But it's not uncommon for us to trade in excess of 1 million shares a day. So it's a very liquid stock, very easy for people to get in and out. And right now, trading near the lower end of the trading range. As I mentioned, great cash position and working capital. It's important to point out the leverage to the silver price. Right now, everything is depressed, and the mining stocks are trading below the silver price. But as things turn around, that's when you really start to see the leverage. And we've seen that in the past, and I'm sure we'll see it again in the very near future. So just in summary, Great Panther is a relatively low-cost producer compared to our peers. Excellent leverage to the silver price. Importantly, we have a very strong balance sheet at the moment with no debt. We've been able to grow our production and drop our unit costs quite substantially, and still have significant growth potential both at our existing mines and with 2 terrific new projects that could take us from about 4 million ounces currently to up to about 10 million ounces within 4 to 5 years, and great liquidity on 2 stock exchanges. So I'd encourage you to have a look, and please come by the booth, and be happy to answer any questions for you. So thanks for your attention.